Welcome everyone to today's Lunch and Learn. We titled this session, Is Fintech Boring Now? Not to be cute, but because this question keeps coming up in investor conversations. A few years ago, Fintech was loud, huge valuations, massive funding rounds, and headlines about banks being obsolete. Today, fewer headlines, fewer unicorns, and a lot more skepticism, especially from investors. Today, it's quieter. So the real question isn't whether fintech is boring. The real question is whether that quiet is a warning sign or an opportunity. To explore that, I'm joined by Gina LeBlanc, CEO of LockTrust, who's building fintech infrastructure in the real world under real regulation. Jean-Marc, a fintech infrastructure investment expert who spent years deciding where capital actually belongs once the hype fades. Let's start with a quick temperature check. Before we jump in, let's take a quick poll. Which statement best reflects how fintech feels as an investment today? There's no wrong answer. This just helps frame the conversation. What's interesting is that skepticism itself often shows up right before a new cycle begins. Jean-Marc, I want to start with you. From an investor perspective, did fintech actually disappoint, or did expectations just get ahead of reality?
Expectations ran far ahead of fundamentals. Fintech didn't fail, it matured. What investors misread was the timeline. They expected consumer tech speed in an industry that moves at infrastructure speed. Once growth slowed and regulation showed up, capital panicked. But that's not a failure. That's the system stabilizing.
Gina, from the operator's side, did it feel like fintech lost momentum, or did the work just get less flashy?
Less flashy is exactly right. When you move from look what we can do to this must never break, the work gets quieter, but far more valuable. Most of what we do now at LockTrust wouldn't make headlines, but if it stopped working, entire businesses would feel it immediately.
Let's level set with where fintech has actually been over the last decade.
From an investor perspective, fintech went through a classic cycle. Early disruption, followed by an enormous capital inflow, followed by a correction. What we're in now isn't decline, it's the post-exuberance phase, where fundamentals finally matter.
Let's name the elephant in the room. Investors pulled back. Hard. Jean-Marc, what specifically pushed capital out of fintech?
Three things mainly. Growth slowed, regulation increased, and fintech started looking like banking without being priced like banking. Capital hates ambiguity, and fintech suddenly had a lot of it.
Gina, did regulation actually hurt innovation or just force discipline?
It forced discipline. Regulation didn't kill innovation. It killed shortcuts. And from an investor perspective, that matters. The companies that survived are operationally stronger, more defensible, and much harder to replace.
So fintech sits in an awkward valuation gap.
Exactly. It's not consumer tech, but it's still priced like it. It's not a bank, but it carries bank-level responsibility. That mispricing is why many investors stepped away, but it's also where opportunity lives.
Let's tackle the word boring head-on. Jean-Marc, when investors say fintech is boring now, what do they really mean?
Boring usually means predictable. Predictable means repeatable cash flows. Most infrastructure investments look unexciting until you realize nothing works without them.
Gina, does that resonate from the CEO seat?
Completely. If your fintech still needs to convince users it's cool, that's risk. The strongest signal today is when customers forget your fintech because you're just part of how their business runs.
Let's make this practical. If an investor says, okay, I'm listening, where's the real opportunity? Jean-Marc, where do you point them?
We see four clear areas. First, embedded finance. Distribution beats branding. Second, payments infrastructure, especially B2B and cross-border. Third, risk, fraud, and compliance tech. AI is finally moving the P&L. And fourth, vertical fintech. Deep domain focus creates pricing power. These aren't moonshots, they're compounding machines.
Gina, from your vantage point, what separates companies investors should trust now?
3 things. 1, revenue quality over growth rate. 2, compliance treated as a moat, not a tax. And 3, real partnerships, not customer churn disguised as scale. Investors should ask, who still works if funding never returns to 2021 levels?
Gina, this is very much your world. Why does embedded finance matter so much now?
Because distribution is everything. The best fintechs today don't fight for attention. They ride inside platforms customers already rely on. That lowers acquisition costs, increases stickiness, and creates defensibility investors can actually model.
So AI gets talked about everywhere. But what actually matters to investors?
Margins. AI reduces fraud losses, improves credit accuracy, and automates compliance. It doesn't just create new fintechs, it makes surviving ones meaningfully more profitable.
We're also seeing fewer players.
That's healthy. Capital discipline forces consolidation. Fewer competitors, clearer winners, and better pricing power. This is what long-term investors want to see.
Gina, from the operator seat, what separates the strong from the fragile?
3 things. First, revenue quality over growth headlines. Second, compliance as a strategic asset. And third, customers who can't easily switch, even if they wanted to. These companies don't look exciting. They look inevitable.
Let's look at the bigger picture.
Banks won't modernize fast enough. Big tech won't take balance sheet risk. Fintech fills the structural gap by replacing bank systems, not banks themselves.
Big timing question. Why does now matter? Why not wait another few years?
Because this is when the power law resets. Valuations are rational, weaker players are exiting, and AI is unlocking margin, not just growth. Historically, this is when infrastructure investors quietly build positions.
Gina, last word from the builder side. What should investors not underestimate right now?
The cost of rebuilding financial trust later. The companies investing now in resilience, compliance, and real integration will be almost impossible to displace in 5 years.
Let's answer the headline question. So, is fintech boring now? Maybe on the surface.
Maybe on the surface. If boring means reliable, trusted, and embedded, then yes, and that's exactly why it's valuable.
And historically, those are the technologies investors wish they'd taken more seriously earlier. Fintech didn't lose its edge, it lost its noise.
The irony is that the things fintech should never be boring about are exactly the things investors should care about most, because they're what compound quietly over time.
The best fintech opportunities are hiding in plain sight, where reliability matters more than novelty. Thank you, everyone.
Thank you for joining.
Thank you, Gina and Jean-Marc, and thanks to everyone who joined us. Let's open it up for questions. Is embedded finance overhype?
Embedded finance was overhyped as a growth story, but it's underappreciated as a distribution strategy. The real value isn't in novelty, but in reduced customer acquisition costs, higher retention, and deeper integration. When fintech becomes part of a customer's workflow, it becomes harder to displace. That's where durable returns come from.
Where does AI actually create value in fintech?
AI creates value where it improves unit economics, not storytelling. The strongest impact areas are fraud loss reduction, credit accuracy, compliance automation, operational efficiency. AI doesn't magically create new fintech categories. It makes surviving companies more profitable.
What risks are investors underestimating?
The biggest mistake investors make right now is assuming fintech risk is mostly market-driven. In reality, the highest risk companies fail because they can't operationalize compliance, underestimate regulatory timelines, and scale product faster than risk controls. Those failures look sudden, but they're predictable.
Regulation isn't a binary pass or fail, it's an ongoing system. The risk isn't, will regulators shut this down? It's, can this company absorb regulatory pressure without breaking its economics? Hidden risks investors miss are over-reliance on third-party rails, thin compliance teams masked by automation and customer concentration inside embedded models.
The riskiest fintechs don't look risky until they hit scale.
And what should fintech never be boring about?
Fintech should never be boring when it comes to security, uptime, and customer impact when something goes wrong. Mostly works isn't acceptable when money is involved.
From an investor standpoint, the most valuable fintechs obsess over risk management, system integrity, and long-term reliability. That obsession doesn't show up in demos, but it shows up in survival.
Fintech didn't lose its edge, it lost its noise, and historically that's when serious capital starts paying attention.
Thanks, everyone. See you next week.